We're now going to look at tutorial week 8 focused on predominantly IAS 38 and IAS 40. So the first question then looks at a stable PLC, which is 3 different properties. And you're given information about each of those properties here in terms of cost and their relevant valuations. And then some other information about some intangible assets acquired during the year. So you have 3 separate requirements. So again, I'm assuming you've tried this before you look at the solution. So I'm not going to read through the whole question. We're just going to kick into requirement 1. Outline all the journal entries required to account for the above properties. So grey mare, black horse and white horse for the year ended 31st December 2013. So we'll take each of them in turn. So grey mare is a freehold factory used entirely by stable. So that means actually this falls under the remit, if you're writing it down, IAS 16. So it's be used by the company itself, useful life of 50 years and bought on the 1st of January 2008. It has land and buildings revalued at the end of last year and revalued at the end of this year. As you're told in the question, in IAS 16, properties are accounted for using revaluation method. So you need to make sure you read the full question as you account for it correctly. So in terms of grey mare, we'll work our way through it. So grey mare, first thing you'll write down is IAS 16, PP. The reason, of course, is because it's been used entirely by stable. So it's not rented out for rental income or capital appreciation. You have to treat the land and buildings separately. So that's important. The first thing is land. It cost 10,000, or in this case it's probably 10 million, but we'll just leave off the last 3 zeros. The reval 31st to 12th 2012 was up to 15. So that was a reval gain last year. So you need to figure out what happened before, as we know in IAS 16, because it will impact what you do this year. So that was a reval gain. And the nice thing about land is, of course, there's no depreciation. So in last year's accounts, it would have been debit land, credit, reval reserve, or reval surplus through the OCI, 5,000. Right, so that technically wasn't asked, but you do need to know what happened in previous years to be able to adjust this year. And you have to look at land and building separately because one is depreciation and one doesn't. So then in 2013, the reval 31st to 12th 2013, it's gone down to 9,000. So that is a reval loss of 6,000. So just be careful now, you're going from the 15 down to the 9. So 6,000 reval loss. But remember, this is now a second reval, a subsequent reval, and you had a previous reval that was upwards. So we know under IAS 16, you're going to credit land, simple 6, because of course, we credit PPE, so that could be PPE is fine as well, because technically it's part of the property as well. Then you're going to debit the reval reserve, the 5. Because of course you had a previous reval upwards, that is wiped out first, and the remaining 1 goes to the P&L. So that's when you have a subsequent reval, first one upwards, second one downwards. So that was nice and straightforward to start off, because of course that was land, there was no depreciation on it. But make sure you have a look now at the buildings element before we actually start it, because that's where there's depreciation involved. So the building then, let's have a look at it here. 24,000 the cost, or 24 million. And then we want to know what was the net book value as the 31st to 12th, 2012. So that was the revaluation last year. So you're saying that was all 8, all 9, all 10, all 11, all 12. So your accumulated depreciation will be 5 years. So it's going to be cost 24, accumulated depreciation. You're told 50 years times 5. So 2,400. So your net book value then is one minus the other, which is 21,600 at last year's revaluation date. And it was revalued to 30,000 last year, which is a reval gain. And that reval gain is 8.4 million if you're doing it in full numbers. So remember there, it's 5 years depreciation, full year in 2008, full year in 2012, because the revaluation is happening at the end of 2012. So you have to depreciate before you reval. So what would the debits and credits be then? Just for completeness more than anything, you didn't have to give these, but you need to know what happened before you went on. So there's 2 steps. You clear out accumulated depreciation and you credit PP cost, and that will be 2,400. And then you will debit PP cost. So that's bringing it down to 21,600. You're going to debit it 8,400, which brings it up to 30. And you're going to credit reval reserve 8,400. So that's what would have happened last year. Right, so you know in your revaluation reserve now you had 8,400 from a previous reval. So your net book value, which is the year we're worried about, 31st to 12th, 13, that is going to be 30,000 minus 1 year's depreciation, which is 30,000. Just be careful now. You're not told of any change in the useful life, so it's going to be divided by 45. 50-year life to start with, 5 years used up. So that means the net book value there will be 29,333. So your depreciation is 667 for 1 year. And your revalued amount at the end of 2013 is going to be, it's gone down to 20. So you have a reval loss here of 9,333. Right, so remember, same situation as before. You get rid of accumulated depreciation, which we said was 667. 30 million divided by 45 years. So 30 divided by 45 is 0.667. And you credit PP cost, 667, which brings it down to 29,333. And then you will credit PP cost 9,333, which is the loss. This is where you have to be careful now. This is a subsequent revaluation. So that means that 8,400 is cleared out first in the reval reserve. Similar to what we did with land. Reval reserve, 8,400. And the difference, debit SOPL, whatever that difference is, the 933. All right, so that's an important one. That was looking at difference of land and buildings, number 1, and also the difference between a first-time revaluation and a subsequent revaluation. So it's the complexities in IAS 16. There's no harm to cover it either. So we'll go on then and we'll have a look at Black Horse. Black Horse, freehold office building let for 50 years to a large insurance company. And we know Black Horse is IAS 40. So we'll write that down because it's a let out. That's IAS 40 investment property. Just put a bold there for grammar. And what we're looking at here is you're told investment properties are held at fair value. So that means when we're looking, we don't really are concerned about 2008, 2012 because there's no depreciation at play. So actually Black Horse is quite straightforward here, that when you come and you look at it, all you're doing is increasing the land and buildings of 100,000 in 2012 up to 102,000 in 2013. So if you want to look at that, the value 31st to 12th 2012 is 30,000 plus 70, which is 100, and the value in 2013 is 27,000 plus 75. So you can look at them separately if you want, but the point is there's no difference here because there's no depreciation. We know under the fair value method or of IAS 40, you do not depreciate. So that is a fair value movement of 2,000. So the simple entry there is debit investment property and credit SOPL. 2,000, 2,000. So the fair value model is a lot more straightforward than the cost model. So it's just important you read the question carefully. What was the actual depreciation policy? And now you make sure you're reading it carefully, because a lot of students skim through it assume it's one model when it actually could be the opposite. The same then with Whitehorse. We're told here, Whitehorse, the property sublet to a shipping company. So again, we'll write it down to get your marks, IAS 40. It's an investment property, you would rent it out. And what you're doing here is, it's also at its fair value, because you have to hold all of them at the same approach. So you do the same as the last one, there's actually no difference. The fair value at the end of 2012 was 40 plus 80. The fair value at the end of 2013 is 50 plus 100. So that is 150. So that's a fair value movement increase of 30. You don't need to worry about depreciation. You don't need to worry about previous years, because the fair value model is actually a lot more straightforward than IAS 16. So all you do there is 30,000 and 30,000. And that is for Whitehorse. But just make sure you put down why you're doing that. It's IAS 40 and it's the fair value. So you'll get your marks, and make sure you read the full question, because you've seen here, if you just read this as far as here, you wouldn't have realized what the policy is. That IAS 16 is at the revaluation method and that IAS 40 is at the fair value method. It just takes a small bit of care, particularly in exam questions. So that's those three complete. Number 2 asks us then, how would the accounting for Black Horse Road change if the cost model was used since acquisition? Right? So we're looking here then at number 2. This is number 1 up here. So put up there 1. So we're looking here, well, if the cost model was used, depreciation must be charged each year on buildings only. The investment property would be carried at net book value. The fair value would be disclosed in the notes to the financial statements only. No adjustment for it. So that's the key thing we're looking for here, is if the cost model was used in IAS 40, then you would have to charge depreciation each year. So you'd go back to Black Horse and you'd say, right, depreciation, land wouldn't be depreciated, so it'll be held at 25,000 every year, or 25 million. The buildings would be depreciated 60 million, and you charge depreciation, if you wanted to come to it, depreciation would be 60 divided by 50, which in this case here would be 1.2 million a year. And you'd reduce that off every year. You're not worried about the fair value, because you're not holding it at that model, but you're a good student will note in IAS 40 it does require you to disclose the fair value of the investment property even though the cost model has been used. So that's the key point to get your full marks. You would have to be disclosed in the financial statements. Right? So that was just a little extra one to see, do you know the difference between the cost model and the fair value model? And a good student, if you wanted to show the net book value at this date or this date will be X, that's fine as well. I don't necessarily say about calculations there, and if it was the exam, I will put in a little extra note to say no calculations required. Or sometimes I might say show it with calculations. So I will be more clear, or clearer should I say, in any exam question in regards to that. So the last part of this question 1 is part 3. And this is asking you outline all the journal entries required to account for the patent and the machine for the period 31st December 2013. So you acquired a patent at a contract cost of 400 grand on the 1st of October. It's for manufacturing a new type of saddle, and they also purchased a machine to produce the new saddle at 600,000. Right. Legal costs came to 20,000, and at the year end, the company received an offer of the patent of 600 grand, and the director wants to put in that valuation at the year end. So the patent is an estimated useful life of 5 years, and the time apportion intangible asset amortization. Production of saddles will commence in early 2014. Well, the first obvious thing to do is you're going to debit intangible assets and credit bank the 400,000 because you paid that contract or the patent, you bought it during 2013. So that's an obvious one to start with. You also purchased the machine at a cost of 600,000. So again, you're going to debit plant and machinery and you're going to credit bank 600,000. Now, we're not given any information about the useful life of the machine. So in that case, we can't actually charge depreciation. The patent has a useful life of 5, but you might say there, well, we're not sure what the useful life is. So you can make an assumption if you want, or just put down, we're not sure what the useful life is. So you can't actually charge depreciation because you don't know how many years to allocate it over. What we do have to do though is the legal costs in relation to the overall transaction count to 20,000. Now you kind of have to make a call here as to, well, we know under IAS 38, which the patent falls under, or under IAS 16, which the machine falls under, tangible assets, legal costs are allowed. But legal costs relate to the overall transaction. So some of those legal costs should be attributable to the machine, some of them should be attributable to the patent. So the most logical thing to do is allocate them pro rata. 4 over 400 plus 600, 600 over 400 plus 600. That's a tricky one, just to see what you would do with it. So you're going to debit plant and machinery, you're going to debit intangible assets, and you're going to credit bank. And they are the legal costs apportioned to each asset based on cost. So what you're saying here is you paid 20,000 for the legal fees, but they are directly attributable costs. Some of it to the intangible asset, which is the patent, some of it to the tangible asset, which is the machine. So what we do here is we say 20,000 times plant and machinery was costing 600 divided by 1,000,000, which is 12. Now where's that coming from? We're saying both them together are 1,000,000, but the machine is worth 60%, so it should get 60% of the legal costs. The patent was costing 400,000, 40%, so it should get 40% of the legal costs. Now that was a tricky one, but you can't really just say it's the 20,000 is attributable to one or the other. So it's reasonable to allocate then the fees based on the portion of cost each of them represent. Right. The last thing then that they mention in the question is the patent has a useful life of 5 years and nil residual value. So that patent of what's going to be now 408,000 is going to be allocated over 5 years pro rata. But this was important. There's going to be no amortization in 2013. Amortization of patent in 2013. It only starts in 2014 when the sales or when the production commences. That's the key point. It's only when the production commences will you start amortizing it, and you amortize it pro rata. That means month by month. Now there is a bit of judgment in the last element that was brought in here, that at the year end the company received an offer for the patent of 600,000 and the directors wished to incorporate this for valuation in the accounts. So we know, and this is another element of IAS 38, we know there's the cost model and there's the revaluation model in IAS 38. But you can only revalue intangible assets when there's an active market. Now, the key point is here, this doesn't give you evidence as an active market. An active market is where you can buy and sell these particular assets at the same price interchangeably. You need a bit more information than just the company received an offer. So what you're saying here is, we want students to write down is there an active market? No adjustment for 600k offer, as no evidence that an active market under IAS 38 exists. So they're quite strict in terms of what an active market is. An active market is where you could buy or sell these particular assets at a homogeneous price, like you can buy and sell milk, etc. There's an active market there. It's not just a one-off transaction. So it doesn't really give us evidence there. And often when we're going from AF2 to AF3 to your Masters, we're looking for increasing judgment. So we're just starting to bring in an element of that where there's going to be grey areas. And what we're trying to get students is to show that they know the key criteria in the standard. The key criteria here is an active market exists. It's not really clear whether an active market exists. Where did the offer come from? Is it a genuine offer? And what you're looking for in questions is, does the question mention an active market? If it doesn't, oftentimes it's usually assumed that intangible assets, because of their nature, do not have active markets, which is different than when you'll be coming across IAS 16, which of course most of them will have an active market in terms of property, plant and equipment. So that was a nice question looking at IAS 16, IAS 40 and IAS 38. So make sure you're comfortable with those and go back over that solution again. So we're now going to look at question 2 in the tutorial, GrowCo. So again, 3 different issues, which is not dissimilar to some of the past exam questions in terms of question 2 and 3, where there's multiple issues. And you're asked to discuss the required accounting treatment and prepare the required journal entries, and clearly explain your answer making reference to relevant standards. So the key point here is, when you're doing the questions, you must explain your treatment. So reference the standard, why you're treating it that way, and then provide the journal entries. So issue 1 then, the intangible assets of GrowCo are 170,000 in the trial balance, made up of 15,000 expenditure carrying out customer service and market research, 40,000 relating to the purchase of a customer listing, and 115,000 expenditure on the rights to sell product G. So there's your 170,000, and we have to figure out, are they correctly accounted for under, hopefully you know, IAS 38 is the standard. So we're going to do here question 2, issue 1, and we know what IAS 38 is, to deal with intangible assets. So the first one is the 15,000 expensed on customer surveys and market research. Straight away you should watch out. Research always has to be expensed under IAS 38. So that shouldn't have been capitalized as an intangible asset. So you should reverse that. It should be debit the SOPL expense, credit intangible assets, 15,000. And you just put down there, IAS 38, all research expenditure goes through the SOPL. Right, that's a requirement under IAS 38. So you're told here it's been capitalized because it's in intangible assets, but you know it's wrong. So that's one of the parts complete. 40,000 was spent on purchasing a customer listing. So that's fine because you actually spent the money. So that would have been debit intangible assets, which is up here, and credit bank. And you're told they expect to be able to use this list to obtain new customers during 2013 and 2014. So it's kind of an indirect thing you have to remember here is you have to amortize that 40,000. It's a useful life of 2 years. So you're going to debit SOPL expense and you're going to credit intangible assets 20,000. And that is going to be amortization over the useful life, which in this case is 2 years. So you have to watch for the guidance in the question is, it is correctly capitalized because you purchased an intangible asset, a customer listing, but it should be amortized over its useful life. That's why you're told they're going to use this over 2 years. Then finally, you purchased the rights to sell product G in the Irish market over 5 years. So that's fine. That 115,000 is expenditure on intangible assets. But upon purchasing the rights, you agreed not to sell the rights to a third party for 5 years. That means this intangible asset has no fair value less cost to sell. Because you can't sell it on. It is 0 fair value less cost to sell. Cash flows this year were 85, and the next 4 years are going to be 50,000 each, and the discount rate is 10%. Again, this is tricky exam level. What are they getting at here? They're getting at the fact that intangible assets are covered by IAS 36 in terms of impairment. So they want you to judge, is this asset impaired at the end of the year? So is it impaired? So what we're looking at here is, we're looking at the cost was 115,000, and your amortization for 1 year will be 23. So the net book value of the 31st of 12th, 2013 is going to be 92,000. That's an important point. And that journal entry for the amortization would have been debit SOPL, credit intangible assets, 23,000. You could say there credit accumulated amortization if you wanted to. All right. That's the first element. So you now have to test for impairment at the end of the year. So it's an intangible asset. You have to test for impairment. They told you that you cannot sell on the rights for 5 years. So that means the fair value less cost to sell here is nil, as you cannot sell on the rights. You're told that in the question. So we then have to figure out what is the value in use for this particular intangible asset and see if or not the asset is impaired. So the trick is, so what we're looking at then is the cash flows. So we're going to have 4 years cash flows. Notice we're doing the impairment test at the end of the year. So that means this 85 is not relevant. You're doing it from 2014 onwards because you're comparing it to the 92. So it's 50,000 each year. And we need to get the present value of those cash flows at 10%. So it's 50,000 divided by 1.1 to the power of 1. So your cash flow over 1 plus R, the discount rate to the power of n, the number of years. 50,000 divided by 1.1 to the power of 2, divided by 1.1 to the power of 3, and divided by 1.1 to the power of 4. So your value in use there is 158,000. And that is also now your recoverable amount, because it's the higher of the fair value less cost to sell, which is nil, and the value in use. So in that case, the net book value is lower. So that means there is no impairment of the intangible asset at 31st to 12th, 13, as the recoverable amount is larger than net book value. You're only worried if the net book value is larger than the recoverable amount. So in this case, the only adjustment for these product rights is to charge amortization for the year. But you had to read between the lines and say, why am I given all this information? IAS 36 is relevant here as well. All right, so that's dealt with issue 1. So have a look then at issue 2. You're told after a profitable number of years, Grubco purchased a new investment property on the 1st of January. Cost of the office block was 500, expected useful life, 50 years, and annual rent of 40,000. And at the year end, the office block had increased in value to 600,000. Now, this is tricky because I told you down in issue 3 that Grubco uses the fair value model for its investment property. So you actually had to use that information here to bring it back up here. So you're not using the cost model here, you were using the fair value model. So this is issue 2. You're going to IAS 40, fair value model. So you'll debit investment property, credit bank, with the initial cost, 500,000. So remember, you asked for all the journals, you must give each one. So at the initial outset, you bought it. During the year, you're going to debit bank, credit other income, or rental income, 40,000. Because you earned rental income during the year. I'm assuming it's paid. You could have said rent receivable in current assets as well, if you assume it wasn't paid. And because you bought on the 1st of January, I'm assuming it's rented out for the full year. You don't charge depreciation based on 50 years because this is not the cost model. What you instead will do is at the end of the year, you will debit investment property and you will credit SOPL. It can go on other income. It can be netted off against expenses, 100,000. And what that 100,000 is the 600 minus the 500. It's the increase in the fair value of the investment property over the year. That's how the fair value model works. It doesn't deal with depreciation. It just recognizes the movement in the fair value at the end of each reporting period. So that was a nice straightforward one. But again, we're trying to get you to think about the difference in the different models, the cost model and the fair value model in terms of IAS 40. And what you will notice is you will have to identify what they are. You have to know that's IAS 38. You have to know that's IAS 40. So the last one then is issue 3. Right? So in issue 3 here, what we're looking at is they also own 2 other properties, property A and B, with the following information. And you're told for the last number of years, property A was its headquarters at GrowCo, and property B was an investment property. So property A was IAS 16, sorry. Property B was IAS 40. And GrowCo used the revaluation model for property, plant, equipment. That's why there's a reval surplus here. And then they used the fair value model for investment property. However, at the end of the year, there's a swap going on. Headquarters, property A, their current headquarters is going to be leased out. Their current investment property is going to be used as the headquarters. So you're swapping a PPE to, if I write it down to make it clear, property A is going from PPE, IAS 16, to become an investment property under IAS 40. And property B is going from an investment property under IAS 40 to PPE under IAS 16. This is an important one that we covered in class around the transfers and what the rules are. Right? And they want to figure out then how are we going to account for this transfer at the end of the year. Well, the key point is when there's a transfer, so we take property A first, you account for A as PP up to the date of transfer. So what that means here is up until the 31st of December, you account for this as property, plant, and equipment in terms of the revaluation. So let's have a look at this. So property A's carrying amount is 950 at the end of the year. And you're told its revaluation amount is 990 at the end of the year. So you're going to revalue this. We don't know what accumulated depreciation is. So we're simply just going to revalue it upwards. We're going to debit PP 40, 950 up to 990. And you're going to credit reval reserve, or reval surplus 40. Because it's upwards and you previously had upwards, it's quite straightforward. You add it onto it. We're assuming depreciation is already accounted for because you're given the carrying amount at the end of the year. And we don't have it split out between costs and accumulated depreciation. So the only other extra step then is debit investment property, credit PPE, just be careful, 990. So what we're showing here is you value it up at the end of the year in the existing treatment, i.e. IAS 16, and then you transfer it over. So now going forward, you're going to have an opening investment property on the 1st of January 2014 of 990, property E. For property B, you account for B as investment property up to the date of transfer. So up to the date of transfer now, investment B or property B is going to be treated as an investment property. So the carrying amount was 820. There's no such thing as a reval surplus. And their valuation at the end of the year is 850. So you simply debit investment property. In this case, it will be 30. And you don't credit reval reserve, you credit SOPL. Because of course you're treating it as if it's IAS 40. And then at the end of the year, once that's complete, you debit PP 850 and you credit investment property 850. So it's just a simple thing, but it can happen from time to time where you swap and you have to be referencing there IAS 40 and IAS 16. And the general rule is you treat the property up until the date of transfer as its existing use. So property A, existing use is IAS 16, up until the date of transfer, then you transfer it over. Property B was investment property up until the date of transfer, so you leave it at that, and then you swap them over. So that's a nice example. We usually don't get into too much complexities around transfers from IAS 2, but you definitely need to know transfer from IAS 16 to IAS 40 or back from IAS 40 to IAS 16. Right. So that was a good tutorial question covering IAS 38 and covering IAS 40 in these issue 2 and issue 3. But you need to be able to explain in narrative form and you need to be able to identify quite quickly what the relevant standards are. Alright, so that was tutorial week 8, focused predominantly on IAS 38, intangible assets, and IAS 40, investment properties.